Unit 231, Portfolio Manager Operations, Capital Triggers. Capital flows like a river, shifting with the tides of opportunity. Economic shifts, political decisions, and market movements create moments, triggers, where strategic inflows and outflows of capital can make or break returns. Triggers can be anything from interest rates to global crises, and how interim capital can be applied for growth and stability. It's a significant skill for a portfolio manager to be able to identify these to capitalize on opportunities that others may not see. Economic conditions like higher interest rates in a country can attract or repel capital. If country A offers a better return than country B, then investors will chase profits where regulations are light and incentives are strong. Stability matters too. A booming economy draws foreign cash, but if there's instability, then capital flows to safer shores. These conditions aren't static, they're signals that PMs need to hear through the noise. Market dynamics like liquidity drive activity. When it's high, investments surge, pushing asset prices up. When there's low liquidity, it's tough to find opportunities worth the risk. Market sentiment from social media, productivity reporting, or Fed announcements can create or destroy investment opportunities. These cycles and moods aren't just noise, they're data points for deciding when to invest or pull back strategically. Public policy also has a hand in shaping the game. Tax breaks or capital controls can lure investors in or scare them off. Countries with trade surpluses often see inflows, especially if others need their savings. Portfolio managers watch shifts that may cause new regulations that could block capital flight, but they also open doors for those who understand the rules. It's about timing and knowing the landscape. On the global scene, there are things like American policy pivots, supply chain interruptions, and raw material shortages that can shake up the investment world overnight. A falling currency might spark outflows, but for some, it's a chance to buy low. These moments demand agility and may not be disruptions, but act as entry points for those ready to act fast and think long term. So, what does a portfolio manager do with this capital? They could just rebalance the portfolio with the additional monies to increase the existing exposure. Or that inflow of capital could be allocated to private companies seeking to fund a short term project or bridge gaps to bigger financing. The expectation is that providing these funds will return a profit. There's also counter-cyclical investments such as government bonds or utility stocks that can be conservative circuit breakers. A PM could also consider greater diversification to spread risk around a little more. There may be adjacent sectors to the primary investment that capitalize on the primary investment's strength. Keeping up with global indicators, policy shifts, market vibes, and liquidity trends is necessary to keep investors' capital aligned with the strategy. Portfolio managers need to know what to do to react to an alert, but what may be more important is how to be proactive on recognized opportunities. Unit 231, Portfolio Manager Operations, Capital Triggers.